the good, the bad, and the not so ugly. Had several emails, of course, this week relating to trades on Meta, old Facebook, of course, with the movement that that stock had. And it was quite a shock to some, with the stock gapping up from 150 close of Wednesday to about 182 Thursday morning, going as high as about 195, then ebbing back down near the close of today to about 187, 186.50. Some of the positions that are shown here are some of the positions I was emailed about. The crazy M signature one there, that is a double diagonal. The same strike, double diagonal, with the 162.5 call sold and the 162.5 call bought a week out, the 133 puts used, and of course now the stock at 195. The loss isn't huge, but it's at a loss. What can we do to manage that position? A calendar put spread that I really didn't like because the structure of the calendar put that was used, it was a calendar put, excuse me, but it was a true calendar put with the same strike. And you can see there was a low upper to lower break even, and that trade didn't work out, and a bear call spread that is essentially near full loss. Now I've entered these three positions into the power options portfolio. We're going to take a look briefly at each one. We're going to talk about some analysis in those cases and what might have been done even in the absolute worst case scenario. So let's go ahead now and navigate over to power options. Here we go. Excuse me. As you can see, the three stocks I mentioned, Anet is down only 1.1%. At the close, Schwab was up 240, and NEM is still falling, and I need to make some kind of rationale adjustment on that one. Even though it's still at a profit, I might want to decide to close it, or I think I want to do a different adjustment on that position. But gold and silver have been tough as well to judge in these type of markets. Newmont Mining, not directly related to gold and silver, but it's going to move with gold and silver. And it's been tough to navigate that as it hadn't worked out as a hedge in 2022 as investors inspected when the market went down because the dollar was so strong. Did have the rally that I wanted when I got into the Marriott put position. Have been able to bulletproof it, but again, need to do something else with that one. But let's navigate over the portfolio tools and let's take a look at the Meta position. Here's our custom spread, that double diagonal trade, where the puts are essentially going to expire worthless. Sold the 162.5 call and bought the February 17th 162.5 call, and they're almost about the same price right now, about $1 difference. The debit to enter this position here was essentially 233. The loss, if liquidated, is 136. Not bad monetarily, but still 58% of the cost that was paid into the position. So a 60% loss, roughly, of the debit entered into the trade. The bear call credit spread, this one is near full loss. And I had another email from a gentleman who is in a better position now. We'll take a look at INTU as well to see what we can do now. And then, of course, the other one is the good. Investor entered a Marriott put position, bought Meta before the earnings at 150, bought the April 160 put for $14.20. Yes, the put's down to only $3, but with the stock up 186.53, looking here at about a 16% profit. Are there ways to lock in that gain, ways to do adjustments following in the rules in the blueprint? Absolutely. We'll take a look at those. But first things first. Let's take the crazy trade first. I don't mean crazy trade. It's just not something I like to do. But here is that double diagonal position. And I went in depth with a customer who asked about this to show some potential rollout opportunities. What the customer initially thought was, yes, we're going to allow the two puts to this put to expire worthless. And of course, this put, even though it's 14 days out in time, is essentially worthless. And it was an advanced strategy, but just bear with me. Something has to be done with the call. 162.5 call. The stock was at 190. Now it's at 186.53. It's deep in the money. And we're nearing full loss, especially if assignment is allowed on that call. Now, just looking at these two positions, the puts. I bought a 17th of February 133 put for $321 and sold the near term for 214. Double diagonal is an earnings play. That's a debit of 107 for that strategy. Now, this one is essentially worthless. It's about 3 cents. This one expired today, so let's clear that one out. This one, okay, we might get 3 cents if we sell to close it. So we paid a debit of 107 just on the calendar put spread. We'll get maybe 3 cents back for this one if we sell to close it right now, with meta up to 186.53. So let's clear that out. That was a debit of 107, get 3 cents back. Let's add 104 to our cost basis of the long call. So that's going to be $4.62, accounting for the loss on the put spread we just took. And where do we stand right now? We're left with a calendar spread, essentially with a upper break even of 172.42. We need the stock to fall back in price. But remember, something has to be done with this call, because if we allow it to be assigned, we didn't close it before today's close, then it'd be at full loss on the position. So let's simulate buying it back, and where does that leave us? There's the February 3rd, 162.5 strike. When I looked at it earlier, it's about $25. Right now, it's probably about 24 at midpoint. Okay? So let's simulate just buying that back, and what does it leave us with? All right, sorry, folks, there you go. So we're going to simulate just buying to close this at the current midpoint price. Now, let's just round this up here. Let's just leave it at 23.98. There we go. All right, so now this leaves us in it's a little bit better than it was earlier this afternoon, but this leaves us now in the position, essentially, we've got one long call to February 17th for a cost basis of $26.28. Now, the customer's original idea was to lower that break even that we initially saw at 172 by simply rolling out the February 3rd 162.5 call that we had to buy back at 23.98 for a credit to the 10th, the next week in between. Not a bad idea. My covered call got in trouble, I roll it out. If I'm in a standard calendar spread, my short call gets in trouble, I roll it to a different strike and I try to roll for a credit. But because the time value is going to start ticking, that is not what I wanted to do. 26.28. I'm sorry, I put the wrong one in. Sorry, I cleared the wrong one out. So the February 17th, 162.5 call, my apologies. That's going to have us our new cost basis of 26.28 from one contract. When I looked at it earlier today, I think it was up to about 29.87 or 29.17, something like that. But you see here, of course, the loss is that call is only worth about $25, a little bit less at midpoint. So there's our loss that we're looking at. Now, if I just rolled up for a credit to the next week out in time, moving my February 3rd to the February 10th, remember we had to pay about 23 some odd dollars to buy it back. Rolling for a credit means I'm sticking with the 160 call or the 162.5, same strike that I just bought back, because now they're so deep in the money, they're almost just both at intrinsic value. This is only a credit of 20 or 30 cents. How would that affect the position? Let's go ahead and add it. And then, I'm sorry. Here we go. So we've added that back in. And we're going to sell one contract there as well. So now the risk is lowered, which was part of the goal. Did lower the risk down to only $200.50. There's a potential return for a 1-to-1 profit if and only if the stock falls 24 points back down to 162.50. Not a high probability of success of the management. Is the risk lowered? Yes, but only by 20 to 50 cents. Is there anything else that's possible with this position? Yes, but it depends on your expectation. The customer felt the stock might pull back, or maybe is hoping the stock will pull back, and that's not how we want to trade. But if I feel that the stock has a good possibility of staying up in price with this new event, even though market conditions are what they are per our previous 15-minute, 20-minute discussion. Rather than just treat this as a calendar spread, especially a same strike spread, which is a very neutral position, I need the stock to fall down another 24 points to get to that break-even mark. I might just go out to February 17th and see if I could treat this position following the new trend as a bull call debit spread. And I'm going to try the 20-point move here. We own that 162.5 call now, remember, for a cost basis of roughly $26, $25, I think it was. Let's take $9 off of that and sell the 17th of February 182.5 call. This will now create a bull call debit spread on this position, a double diagonal that's near full loss, but thankfully the loss was low due to the structure of the trade. We're just going to sell that 182.50 against it. We now have a cost basis of $17.28. Was that about 8 times, 9 times the $200 risk if the stock does pull back now below 162.50? Where his calendar spread might be at a profit, this position would be at full loss, 8 to 9 times that $200 loss. But if the stock stays above 182.50, possibly we could even use the 180. It'd be a lower return, but we'd have a better probability. We've now created a bull call debit spread that has the potential to make a 15.7% return. How is that possible? Because we've lowered the total cost into the trade to $17.28 from that risk of $26.28 of just a long call. We have a 20-point spread, so if the stock stays above here, we're obligated to deliver shares of Meta at 182.50. We bought the right to buy those shares of stock at 162.50, so we get the 20 points back, and there's roughly our profit of $272 on the transaction. This didn't lower the risk the way he wanted to on the trade, but it could turn a losing trade into a winning trade, not by rolling for a credit or thinking we have to roll for a credit, but actually converting it to a debit spread from that double diagonal. A potential, maybe not great. Now, in that line, I had another investor who did a bear call credit spread on this position, a 5-point spread on Meta with about a 63-cent net premium for a 14.4% potential return. And this trade is essentially at full loss. A customer emailed me as, how can I manage this trade now that Meta had come up? A similar discussion I had with a customer on INTU, where INTU was actually up at 455 at one point on Wednesday or Thursday. It had gapped up, but as you can see, it pulled back. This spread was deep in the money and also near full loss on the trade. Now it's looking a little bit better, but because of the volatility, even though this bear call spread's out of the money with 7 days to go, it's still at a small loss of 178. Management is now key. Now, is there anything one can do when the position reaches near full loss, such as this type? Now, this unfortunately is at expiration. There's not much, I'm going to be honest, there's not much that can be done. Playing a vertical spread, straight bear call, straight bull put, bear put debit, bull call debit, for an earnings play, has the potential to reach 100% loss very quickly in the sudden surprise. We don't recommend doing the vertical spreads around earnings as an earnings play. Too much off chance that you'll take 100% loss. If you do decide to do this, make sure this position, the monetary loss in the position, really only represents 1 to 2% of your total portfolio, because there is that inopportune chance you could realize 100% loss in this trade very quickly. Once your credit spread reaches somewhere around the range of a 70 or 80% loss on the trade, management is near impossible. You can try to roll out, but if you roll out and say, oh, I can just move the bear call credit spread out in time, you're going to have to go very far out in time, but you're also going to have to increase the strike difference. See, closing this now is going to take me a loss of about 435. I need a net credit of 435 to get back to break even. If I'm expecting a premium of $5 or $6 to turn this into a profit, just going out 3 or 4 months is not going to work. I'm going to have to increase this 5-point strike difference or this margin up to 20 points, 15 points, which means I'm tripling or quadrupling the initial at risk I had, and I could still lose that if the stock continues up, even if I'm out to June or July or probably September to try to pay that back. The clever adjustments we show, such as the pendulum adjustment and things of that nature, don't work in this case because you're too close to expiration at the time. Now, in the case of the INTU trade, let's just take a look at the chart first. I'm sorry, let's go to big charts. This was this move up. It had breached 430 and around 435. That's when I felt that the customer might have wanted to look to manage the position. You know my 1% rule. If the stock reaches within 1% of our short-term strike price, that's when I maybe want to consider an adjustment. One of the 8 ways we may look to manage a credit spread, bull put or bear call. At this point here, I emailed the customer back and walked through the 8 ways that we may look to manage a bear call credit spread. And none of them worked except for rolling it out in time and either widening the strike difference to up to 30 or 40 points, tripling or quadrupling the risk, or increasing the number of contracts to get the monetary value back of what the loss would be. You know, the 8 ways essentially is number 1, do nothing. Number 2, do nothing. And number 2 is just close the position, take the loss, and move on. No one wants to do that, but sometimes taking at this time, it was a 70% loss on the spread. Well, taking the 70% loss beats 100% loss. I could maybe just close the short option of that bear call credit spread and leave the long call open, but that's going to be very costly. I'm going to need a much bigger move in this direction to pay for that. Or, of course, we can talk about just moving the whole spread up, but we talked about how we'd have to increase the strikes. We could close and do the opposite, but in that case, you have to do the same thing. You're going to have to increase the strike difference or the number of contracts or both to get back the loss you're taking on a standard credit spread position. At this point, when you're at near full loss on one of these trades, the other ideas that we normally discuss, oh, I'm sorry, folks. Let me go back to let me go back to the meta there. Excuse me, such as creating an iron condor to help the break even. Can't do that here. It's not going to help the break even at all. You're not going to get 437 back selling a bull put credit spread on this position. The pendulum adjustment does not work. Where we swing this down to try to create a debit spread, you're too deep in the money. That only works if the stock is between the 2 strike prices in those cases. So 3 or 4 of the management techniques we would use are right out of the window because both options are now deep in the money. The other ones that were used had to wait for too long. Now, thankfully, this position was at full loss. There's nothing that could be done. The customer can decide to continue writing spreads after taking this loss to try to make that back up on meta, keep the same strategy but change to different stocks, or change the strategy sentiment on this particular underlying to try to make back that 437 over time. Now, you're only collecting 40, 50, or 60 cents at a time, so you can see that might take you 8 to 10 months to get back to break even. Even if you're using weeklies, okay, it might take 4 months doing every 2 weeks at a time to get the credit that you want. That's why we don't advocate doing directional vertical spreads or iron condors, neutral positions, or the double diagonals that we saw around an earnings event, because the surprise can lead you to full loss, and you may just have to accept that because no management is available unless you're willing to try to keep managing this same position 6, 8, 10 months down the line. That's the nature of those trades, and that's the risk involved. Now, for our other friend in INTU, not too bad looking now. It is still a loss of 178, but the position is back below the strike prices. Hopefully, you'll see some time value decay over the weekend, and volatility will ebb on this wild ride. But again, as I mentioned, the same thing happened when the stock was way up there in the 450 range. There were no management techniques that we could use. I did reply to the customer back this morning and said, hey, it looks like you've got a drop here. You might see some better management techniques. They hadn't closed or adjusted it yet. So now they're, I think, in a holding pattern on this position, waiting to see what happens next, hopefully getting some decay, or looking to apply one of those 8 different methods that I mentioned. Now, where can you find these 8 different methods, of course? Well, just remember at any time you can go to our YouTube channel. There we go. All right, and go to the videos section. And let me just write in a search on our videos for 8 ways I'm sorry, folks. It doesn't always do that the correct. There we go. So there's 8 ways to manage a bull put credit spread, 8 ways to manage a credit spread, or you could just look up bear call as well. And I want to point this out too. One of the other topics that we had, I don't know if this might help our friend later. I actually forgot to email them this link. But the gentleman with the double diagonal there that we talked about on Meta, here's a discussion from 10 months ago on risks of a double diagonal as an earnings play. I know there's people that teach this out there, but I just don't think this is the right approach to do. An iron condor or a double diagonal there, a neutral position where you don't want the stock to move that much. Yes, you're taking advantage of implied volatility. Yes, you're selling into that higher implied volatility, which investors love to do. But at the same time, you're sort of taking that risk of the surprise movement. You have a better chance of seeing the full loss than you do of seeing the peak profit or the full profit in those cases. So, this is just my thoughts there, but you can check all that out right there on the YouTube channel as well.